Can I welcome Ewan, Lloyd-Baker and Nick Flanagan from Hayward Tyler.
Well, I will be joined by Nick in a moment, but I'm going to start the proceedings. So first of all, good evening everyone. And no, I can't give you investment advice, but what I can do is tell you what a great company Hayward Tyler is, and that's what I'm going to be doing. So what is Hayward Tyler? Well, we're actually one of the oldest engineering companies in the UK, and we are a specialist engineering business focused on pumps and motors for the energy sector. To try and put it into context, in case some of you haven't actually seen us in terms of how big we are, we're an AIM-listed PLC. We've got a market capitalisation of about 35 million. And this year, the expectations by FinCap, who are the house broker, are for an EBITDA of 6.3 million, profit after tax of 3.3 million, and therefore earnings per share of 7.4 pence. So, in terms of just going into a bit more detail about what we do, what you'll see here, and the idea of having this little man standing there, is to try and put it into scale. So we're talking about big bits of kit the size of a car. They weigh 15 to 20 tons. As you'll see from the slide, they're mission critical, difficult to handle fluids, high pressure, high temperature. We use them in the energy sector. We sell to big power stations, fossil-fired power stations in India and China. I'll come on to that in a moment. We sell to oil and gas rigs, or for use in oil and gas rigs, FPSOs, specialist motors. Our motors also power pumps that sit on the seabed and inject seawater into underground oil reservoirs to help squeeze oil out. And I'll come on to that in a moment, given that a low oil price is the hot topic of the day. How do we do it? Well, we've been around for a long time. We actually invented the idea of a wet wound motor, and we've taken that idea and we've used it, as I've said, both in the power generation and the oil and gas. So you can actually run a liquid, the barrier fluid, through the centre of our motor without shorting what is in effect a conventional induction motor. These things are built for the life of the plant. We've got units that have been running, say, in South Africa for 40 years. We've got units that have been running a similar length in time in India and China. We've got about 2,300 of the 3,500 units globally for our core product, which is the boiler circulating pump. Mission critical, innovative energy sector. For us, anything from oil and gas, civil nuclear, power generation, and I'll come on to that in a moment. And for a relatively small business, the opportunities that we see are global. So we're selling into global customers, we're selling into global markets. And you'll see a few of our customers are actually in one of the appendices slides, which we'll come on to. So, what have we been doing, and why have you perhaps not heard of us? Well, we're a relatively small business. We're a 35 million market cap. Where do I want to be? Well, I want to try and be a mini Weir. Aspirationally, that's where we're heading to. Might not be a good example at the moment because their share price has come off 25% over the last 3 months. But in terms of how they've developed and how they've grown over the last 10 years, that's where I think that we can get to and where we want to be aiming for. Niche engineering within the energy sector. Over the last couple of years, what we've done is we've done a root and branch, in effect, review and a turnaround of our main operations. We operate from 5 facilities. Again, this is all in the share pack, but the slide pack. 5 facilities, the main one being in Luton, which is where we do all the original equipment manufacture. And then we have an aftermarket business in the States, a smaller business up in Scotland, and an aftermarket facility in China and India. And about 3 years ago, we embarked on a process of continuous improvement, first of all in our Scottish operations, then in our Luton operations, and now in our US operations. First, everything's about the people. So we might be a product business. Half our business is in effect original equipment. Half is then the aftermarket that we derive from that, having sold the original equipment. But without the people, you don't do very much. So we went through a sort of root and branch review, cultural change of our people in our main manufacturing operation. Very proud last year, one of our young graduates from 3 years ago won Young Manufacturer of the Year. We've recently received a grant from the UK government to invest in Fit for Nuclear, civil nuclear sharing and growth. That's all about investing in the people in our Luton facility, where we have about 220 employees. That's bringing them up to NVQ level 3 and above, training them for the next generation of opportunity within the domestic civil nuclear market. Processes, we won, again, ICT Manufacturer of the Year for our processes. And now we're being used by Rolls-Royce. We're being, as an example of best practice, they've brought Sheffield Forge Masters, amongst others, down to see what we do. And products, now investing in the next generation of wet wound motors and how we apply that technology into other sectors. And frankly, if we do all of that, then by default we're creating shareholder value. And if you look at our performance, which is obviously available to see via the website, over the last 2 years, 18 months, 12 months, 6 months, you'll see that we're continually doing what we say we're going to and delivering the numbers. So let me just take a couple of minutes just to talk through the main market segments in which we operate. You'll see from the slide here, over half our business is still in what I'll call conventional fossil-fired power generation. That's both a combination of the original equipment and also the aftermarket. I've talked about the fact that we are the dominant player for this particular niche of boiler circulating pumps. What's driving that? Well, ultimately it's the economic growth of India and China. Clearly of late, in fact we saw it probably 18 months ago and certainly 12 months ago, the political situation in India pre-Modi being elected, we just saw a complete sort of slowdown. Nobody was wanting to spend anything. Things are beginning to improve, albeit it's taking some time. China actually been relatively buoyant for us, but I guess growth is a relative term. They're still growing at whatever it is, high 6s, low 7% compared to, in effect, a reverse in some other parts of the world. So in terms of our underlying business on the power side, driven by China and India. Oil and gas, interesting. 6 months ago, if I'd stood up and said, right, we're not doing anything in oil and gas, you'd have said we need to be doing more in oil and gas. Now I say that actually the oil and gas business is pretty slow at the moment. And you go, well, that's fine because the oil price is right down here. So it sort of ebbs and flows, if you'll excuse the pun. I think the interesting thing here from our perspective is that what are we doing? We're building these motors which go into this skid, which is about a 30 metre by 30 metre skid. It sits on the seabed and it powers pumps to inject seawater into underground oil reservoirs. We're also doing seawater lift and we're doing firewater motors that go onto rigs and FPSOs, as I've said. Clearly a firewater motor has to work when you need it. You can't rely, you can't rely on it not working. That's hence the reason it's mission critical. So our customers come to us and we're talking about unit values of circa 250 to 350,000 pounds per motor. Top side, we're talking about closer to £1.5 million on the subsea. We have been working with a number of subsea developers, Aker, GE, and we're in the process of working with a number of others, because the whole idea of subsea processing, which is ultimately reducing the number of rigs or FPSOs that you need in order to extract oil from the ground, is, if anything, in my view, going to become more important with a low oil price rather than less important, because you need to reduce the cost of oil extraction, particularly on some of the marginal fields. So whilst we're hearing about people saying, well, okay, there's going to be cuts in terms of the exploration capex and exploration expenditure, as far as what we're seeing, and I guess we are slightly late cycle, we still think there's an opportunity for subsea processing and the idea of a subsea factory. So relatively small part of the business in the first 6 months of the year that you'll see in terms of the statistics there, but we do expect that to pick up, certainly going into next year, despite what's going on at the moment. Nuclear. Again, the fact that we have been around for a long time as a company gives us a fantastic platform on which to build. We supplied the original kit or some original pumps into Calder Hall in 1956. In the UK, the first ever civil nuclear power station globally. But what that means is that we've got a big installed base, predominantly in North America, which is both the US and also Canada. But we're leveraging off that. And again, if you've followed any of the announcement we've made recently, we've got installed kit in Sweden, and we've won one of our biggest orders ever out of our North American business, but that was for South Korea. That was to replace a number of pumps that we have in 2 of the reactors over there, worth over $10 million. Great business to be in, and part of the development now is how we leverage that, and as I mentioned earlier, position ourselves to be, in effect, spearheading UK domestic-based supply chain for Hinkley Point C. So that's a bit of background. Now what I'm going to do is hand over to Nick just to talk us through some of the numbers and bring them to life.
Thank you, Ewan. Welcome, everybody. So I've just got a couple of slides to talk about our KPIs, and they're the ones which we use to measure our performance against strategic objectives of strengthening the business, improving our profitability, and giving a good return to shareholders and investors. So first up, order intake to historical revenue. So a measure, if you like, of the growth of our revenue. Today's order intake is next year's or next 6 months' revenue. A very strong performance in the first half with a ratio of 1.4 times versus a target of 1.1. Good, strong performance in the first half. Cash conversion a little bit behind our target. That was just down to 1 overdue debtor at the 30th of September. Take that away, and the actual performance was 119%. So the underlying working capital control is very strong in the business. Net debt to EBITDA down at 1.4 times, and you'll see the reducing level of leverage in the business, reflecting profitability and reduced borrowings. Then on to profitability measures. We just under our target of gross profit margin of 35% for the half year, but we'd expect that to be stronger for the second half to bring us back closer to the 35% overall for the full year. That's based on the operational improvements we're making in the US original equipment business and from the margins in the aftermarket that we can see in our order book. That's also reflected in the EBIT return for the year, so return on sales, just below our minimum target there of 10% for the first half. Again, we'd expect to be north of 10% for the full year. And then finally, in terms of EPS growth, 63% growth for the half year. If you look at that on a like-for-like basis, that's actually 7% growth. And again, for the full year, we'd expect our growth to exceed our target of 10% on that like-for-like basis. So overall, a reasonably strong set of KPIs for the half year, and the expectation that we can do better and will do better for the second half and for the full year. Ewan.
Yeah, thanks very much, Nick. So just moving on to the next slide, we've got if a picture paints 1,000 words, I could tell you about all the good things that we're doing from our current operation in Luton. I mentioned that it's about 220 employees. It's where we do 95% of all the original equipment. We operate from a 7-acre freehold site there. I don't know if any of you have in effect ever flown in or out of Luton. You've probably seen the roof of the factory next to Parkway, Luton Airport Parkway Station. One of the things that we've been doing is as the business has improved, so we've been in effect lobbying and tapping into the great British government and deciding that it's nice to get something back as a taxpayer as opposed to just always giving it. So we've now got some money in the form of a Civil Nuclear Sharing and Growth Grant and also a Regional Growth Fund grant, which is all about investing in our Luton-based facility. I mentioned the CNSIG grant, which is about training and development fit for nuclear, bringing our employees up to at least NVQ level 3 and above. The interesting thing about the Regional Growth Fund grant is it's not just tied to training, it's also for research and development about the next generation of product. It's also about investment in plant and machinery, and it's also about investment in the fabric of the building. So actually what we're looking at doing here is we currently operate from this building here. It hasn't yet been reclad, so it doesn't look like that. It looks like a 1970s industrial block. But we're building an extension, 75 metres extension, which will give us another 25,000 square feet or 2,500 square metres worth of additional flow line. That will enable us to, in effect, relay out the flow of the shop. It will increase in size terms by about 50% the manufacturing space. In capacity terms, it will double the operation size of our Luton business. That's something that we kick-started, again, if you read the announcement this morning, that we kick-started the demolition already, hoping that will be completed by the end of February, so that we're able to break ground in terms of the new build work by the end of March. Big opportunity for us, clearly very exciting, and I think, it in effect talks to the positive outlook that we think there is across our markets generally. Can't ever say that all of our markets are always all going to be positive, but what we can say is that we've got, in effect, with a combination of original equipment and aftermarket, and a combination of selling into, in effect, China, India, even Eastern Europe, but fossil, oil and gas, topside and subsea, and now civil nuclear, lots of opportunities within those markets for us. And so, in summary, I think the first point I've explained. Nick's already sort of covered off the fact that, what we do as a PLC and what we've done for the last, in effect, couple of reporting periods is we said, these are our KPIs, this is how we're going to measure ourselves, this is how we're, in effect, delivering against what we say we're going to do. Those KPIs we reported on are at the half year, what we're in effect saying, what market expectations are saying about the performance is that we will have EPS growth of over 10%. In fact, if you believe the analysts, it's going to be 12.9% this year, and it'll be 10.6% full year 2016 for the year ending the 31st of March 2016. You'll see also in terms of reduction in net debt to EBITDA ratio, improvement in cash generation, that we've in effect strengthened the balance sheet, continued to grow net assets, and we've actually adopted a progressive dividend policy now 12 months ago, so we paid a full year dividend of final year dividend of 0.775, and we've just done a 5% increase on the interim dividend, which will be paid to all the shareholders on the register on the 23rd of January, on the 5th of February is the payment date. Just because people might not have seen it, in terms of our house broker FinCap, they have set a target price of 113p per share, which compares to our current share price of about 7.79, so about a 45% increase. And that's delivering what we say we're going to deliver, or what the market expects us to deliver on the back of those valuations. I think it puts us on a PE of about 12, or forward PE of about 12 times. So thank you very much, and happy to take any questions.
Any questions, anybody?
Two questions. First, you highlighted the issue you had a debtor who was supposed to be paying you in November and December. I wonder what you say about that for us. And I'm still a bit puzzled. You're getting 3.5 million from me and from everybody else, taxpayers here. And the government, this is just kind of a gift. Obviously you have to spend the way it's stated. There's no repayment, or they don't get shares. It's just a pure grant, is it?
Okay. Do you want to take the first one?
First one we've agreed the arrangement for the debt to be settled in full. In fact, first part of that will be on Friday this week.
And the second part is, yes, like you, I'm a taxpayer. No, it's all relating to job security and job creation. So for every pound we get from the government, we have to commit to create a certain number of jobs over the monitoring period, which is a 10-year period. So it's not only to upskilling, which I've talked about, but it's actually linked to job creation. And as you may know, Luton is in one of the most depraved, or Arwood is in one of the most deprived areas within the Luton borough, which itself is in the bottom decile from a UK perspective.
Hi there. As a government grant receiving, but if you want to receive like continuously, are there rules and regulations you're abiding by, in case they want results back for your success?
As you'd expect, we had to go through a fairly rigorous process of due diligence with BDO who did that. And then what we do is on a quarterly basis we have a monitoring officer appointed by BIS who comes in and makes sure that we're in effect delivering against the programme that we agreed in the first place. Well, the key metric that they're looking at is job security and job creation. So inevitably, a big capital project like extending a building or demolition, I can't guarantee that I'm going to be finished on a particular date. So there's a degree of flexibility over, well, it takes an extra month to do that, are we still going to be able to have access to that pool of capital? But generally it's, we're currently tracking ahead of where we said we were going in terms of job creation. So at the moment we've got a reasonable degree of leeway.
I wasn't sure if I heard what your revenues per year were in the last 3 years, and whether there's a standard growth rate among them. And then do you have any patents on the equipment you're manufacturing?
The revenue over the last most recent period, so 24 million for the half year, 43 million for full year to 2014. March 14. Then we actually had a 15-month period for the period to March 13, and that was 38 million. Is that correct? 40.5, beg your pardon. 40.5, and then 32 million for the year to December 11. Well, we're aiming for more. Aiming for more than that. So. There are some patents in the business, but they're not on the balance sheet, and they are selective. Some of the technology we have in the business, for example, the BCP is way past the expiry date of patent, but there are specific parts, and we do look at protecting new technological developments. It's something we could look at, possibly, yeah. But we don't at present.
Hi, good evening. Just wondering what your growth strategy is for the emerging markets, and in terms of their percentage contribution to overall company revenues at present.
As you'll appreciate, we don't have a single strategy for growth market. The growth markets, because each market's different. If you look at our revenues, I think it was in the first 6 months of this year, high proportion from South Africa, for instance, derived from what we take in order intake 6 months before that. If you look at our revenues in next year, we're not expecting a huge amount of business activity from South Africa, but there's a huge proportion of our business derived from South Korea. China, as I said earlier, has actually been really buoyant. So we've had a number of announcements recently relating to big boiler companies in China placing orders on us. India's been very quiet. We do have in-country people, in-country facilities in India, China. Some countries, South Africa, we do it via a relationship with a specific service facility. The US, which is a significant portion of our business, we've got obviously our 90 employees in our facility there. So it does depend on which particular geography you're doing, and also which particular markets they're talking about. But that's probably as much as I can tell you now without going into too much detail. I'm happy to talk to you later if that helps.
Would you mind just expanding on the oil and gas comments earlier? In particular, what I'm interested to know is in the last 2 or 3 weeks, when you're talking to your customers, are they now actually cancelling orders, delaying orders? What sort of comments are you getting back at this stage?
Not from our customers, no. But then we're selling to the pump integrators. So they're then obviously hearing things from their customers. I mean, we're hearing and reading about it as well. Any sort of exploration is being reviewed again. So all forms of capital expenditure, all forms of authorisation for expenditure, I think getting a second look at some of these big integrators, big integrators. I think we'll see more M&A being driven as a result of the lower oil price. Difficult to know whether if you talk to some commentators, they think it's more of a V rather than a U or an L. As I said, we're late cycle in terms of our business. If it carries on for say 12 months, then it's what we're going to do in 2016. If it carries on for a couple of months, I don't think it's going to make a huge amount of difference.
Would you like to talk about your competitors, particularly as you're now increasing your capacity? Are you going to have to cut your margins and get lower prices to fill the capacity that you're committed to the government to actually employ people in?
Well, we clearly operate. We do operate in competitive markets. If you take the conventional fossil power side, we've got a big German competitor, we've got a big Japanese competitor. On the oil and gas side, we've got a big Norwegian competitor. Our view is that by going through, and it was one of the three areas I talked about, investment in R&D and for the product. One of the projects we're currently working on is taking, in effect, a meter out of the length of the BCP, taking half a ton of weight, improving the efficiency of the impeller design, to improve the efficiency of the pump. So there are certain things that we can do which are in our control. Then the question is how much do we keep versus how much do we give to our customer. That's a separate issue. But we wouldn't be going through in effect the pain of deciding to ultimately extend the factory and build if we didn't think that the long-term future for the business was there. Now the civil nuclear side, as I said, if you start looking at which businesses there are in the UK able to provide our counter-motor pump range, very few. So there's got to be an opportunity, and we're clearly making sure that we think we're at the forefront of that opportunity. Now that might not help in the next 2 years or 3 years, but at some point it will help. And we're then talking about $5 to $10 to $15 million per reactor. So it's an investment worth making.
Gentleman there. Just a quick question. Maintenance agreements. When you sell a pump, do you have a maintenance agreement? And does that give you recurring revenues every year or not?
So if you look at how we sell the original equipment to the boiler manufacturer, so if we take the power side, and then 5, 7 years later we'll go into the power station operator. What we tend to have is master level service agreements with the power station operators that might be for probably a fleet, particularly what we do in the States. So we might have a single agreement which will cover a number of different power stations. And then we'll have how long it takes us to react and what we have to replace certain as part of the planned outage programme. Unlike a Rolls-Royce, say, we don't have a fixed amount of annuity income. But obviously, if you look at our financial performance, what you can see, and what we have stated is that 2 years ago it was 70% aftermarket, 30% original equipment. Last year, I think it was 55-45. It'll probably be a similar sort of level this year. Maybe with the nuclear spares order, it might be 60-40. But the plan is growing the overall business whilst increasing the amount of OE that we sell, because today's OE is tomorrow's aftermarket, so we're seeding the market with future growth.
Thank you.
You mentioned under oil and gas, one of your sectors. Have you got any opportunity in the fracking side of the business? The oil and gas business?
We don't tend. I guess potentially, but we're not doing anything in that area at the moment. Just because the core sort of technology wound means that the price differential between one of our bits of kit versus a dry motor means that we're competitive.
Any other questions, anybody? No? Thank you very much indeed. Thank you.
Thanks very much.